influence the operating and financial decisions made by B Limited. So this company is not able to control the operating and financial decisions of this, but it is purely able to influence. It is able to influence. So therefore, anytime you're given a question and you're told the investor company or the parent company acquired shares, which lies between 20% to 49%, it automatically means that the investee company, this company here, is an associate. Is what? An associate. So that is basically the definition of an associate. And then from there we have the other entities here, and basically that is a joint venture. Joint venture. So when we talk about a joint venture, this is an entity in which the parent company and another entity acquire something called a joint control. So this is an entity where the parent company, and another entity acquires joint control. Acquires joint control. So in this case, when we talk about the parent company and the other entity acquiring a joint control, it basically means that assuming we have two companies, A Limited and basically B Limited, so this company may enter into an agreement to acquire equal shareholding or to acquire equal shares in maybe a company which is called C Limited. So this company acquired 50% of the shares. The remaining 50% of the shares are acquired by B Limited. So in this case, we say that these two companies have acquired a joint control in C. Joint control means that the operating and financial decisions of this company here, that is C, will be jointly controlled by A and B. So A and B will be jointly controlling the operating and financial decisions which are made by C. And therefore, this company here, we refer to this company as a joint venture. We refer to this particular company as what? As a joint venture. Now, having known what is an associate and basically what is a joint venture, the other thing we need to ask ourselves here, how does the parent company prepare the group account whereby the parent company has invested in an associate or invested in a joint venture? Now, the preparation of group account in this case is governed by this particular standard, which is International Accounting Standard number 28. And this particular standard requires that whenever the parent company has invested in an associate or basically invested in a joint venture, the group account, the consolidated financial statement should be prepared using the equity method. So the group account in this case, we can say a group account, all the consolidated financial statements should be prepared using the equity method. So equity method basically is a method of accounting, and this particular method, how is it applicable in preparation of the consolidated income statement? How is it applicable in the preparation of the consolidated statement of profit or loss? So first of all, I want us we look on how this method is applicable when it comes to the preparation of the consolidated statement of profit or loss. So how do we apply this method? Now, number one, when the parent company has invested in an associate or basically a joint venture, and we are preparing this, we are saying we should be able to do that in accordance with the equity method. Now, this method requires one, when preparing this, similar items of revenue and expenses, those of the parent company and those of the associate, or those of the joint venture, should not be consolidated, should not be combined. Should not be what? Should not be combined. So if the parent company has invested in an associate, has invested in a joint venture, you are preparing this, the consolidated statement of profit or loss, we are saying use equity method. And actually, according to the equity method, we are saying don't consolidate. Don't consolidate similar items of revenue and expenses, those of the parent and those of the joint venture. Like what we are doing in case of an investment in a subsidiary. We said in our previous discussion, once the parent company has invested in a subsidiary and you are preparing this, you should combine similar items of revenue and expenses, those of the parent and those of the subsidiary. But in this case, we are saying we don't do that. So instead, what we include here, as far as the associate or joint venture is concerned, is the group share. The group share, low associate, or basically joint venture, profit after tax, and other comprehensive incomes. Another comprehensive income. So what we need to do basically is to determine what is the parent company share of the profit after tax and also the other comprehensive incomes which were reported by the associate and also the joint venture, and then we include them within the consolidated statement of profit or loss. But in this case, we are saying never make a mistake of consolidating revenue and expenses, those of the parent, those of the associate, or those of the joint venture. Instead, what we include here is the parent company share of the associate or joint venture profit after tax and other comprehensive income. Then from there, let's look on how this method is applicable when it comes to the preparation of the consolidated statement of financial position. Consolidated statement of financial position. Consolidated statement of financial position. Now, first of all, recall what we said in our previous class. Anytime the parent company has acquired a subsidiary and you're required to prepare this one, consolidated statement of financial position, we said you combine, you add together similar items of assets and liabilities, those of the parent, those of the subsidiary. Is that what we do here? No. So according to the equity method, when preparing the consolidated statement of financial position and the parent company has invested in an associate or basically a joint venture, we don't combine similar items of assets and liabilities, those of the parent and those of the parent and those of the associate or those of the joint venture. So in this case, we can say similar items of assets and liabilities, assets and liabilities, those of the parent company and those of the associate or those of the joint venture, they are not consolidated. Not consolidated means that they should not be combined. They should not be combined. Like what we are doing in case of an investment in a subsidiary. Here we don't combine. Instead, what do we include here? What do we include in the consolidated statement of financial position as far as the associate or the joint venture is concerned? We include something called the investment in associate, or basically investment in what? In the joint venture. So we have to compute something called the investment in associate, or basically investment in what? Joint venture. And actually we include that, we recognize that as a component of non-current asset in the consolidated statement of financial position. So how do we compute this one? To compute the investment in associate or the investment in joint venture, we start with the cost of investment. So the cost of investment, basically, this is a purchase consideration which was paid by the parent company in acquiring the shares of the associate or basically acquiring the shares of the joint venture. So how much purchase consideration was paid? And then to this we add the group share of post-acquisition retained earnings, and any other post acquisition reserve. Any other post-acquisition reserve. So when we talk about the post-acquisition retained earnings, post-acquisition reserve, this refers to any reserve of the of what? Of the associate, or basically the joint venture, after it was acquired. So the retained earnings of the associate of the joint venture after it was acquired, or any other reserve of the associate or joint venture after it was acquired, or which must be a post-acquisition, which must be a post-acquisition. So compute the group share of that. And then to this, you less impairment loss. In most of these particular questions, will be told that the investment in associate or the investment in joint venture had impaired with a certain value. When talk about impairment of investment, this whereby you can invest your money in the company, but that investment loses value. You invested maybe by buying shares having a value of 200,000, but because the company where you invested has been making losses, it has not been able to pay dividends, your investment has reduced in value. The value of the shares you bought has lost some value. So that loss of value of the investment which you made in a company is called an impairment loss. The same case, the parent company may have invested in an associate or joint venture which has been making losses, and therefore you can be told the amount invested in the associate or the joint venture has lost some value. That is called an impairment loss, and basically we should deduct it here. Whatever we get here is basically what is known as the investment in what? In associate, or basically investment in joint venture, and basically this is the only item which is basically recognized. The only item which is recognized in the consolidated statement of financial what? Position, as far as the associate or the joint venture is what? Is concerned. We don't combine similar items of assets and liabilities, those of the parent and those of who? Of the associate, or basically those of the joint what? Venture. Sasa? Yes. So therefore, basically that's what you need to know. But if you can be able to recall what I said, is that most of the questions you'll come across in the past papers, you'll be given three companies. You'll be given the parent company. You're told the parent company acquired a subsidiary, and also the parent company acquired an associate, or basically a joint venture. So you have three companies. Now you have to remember what we have discussed here. We have said in case the parent company has already acquired a subsidiary. So whenever we are preparing this consolidated statement of profit or loss, we combine similar items of revenue and expenses, those of the parent plus those of the subsidiary, those of the parent plus those of the subsidiary. In this case, I've said we don't include the revenue and expenses of the associate here, So we don't consolidate the revenue and expenses, those of the parent and those of the associate, or those of the joint venture. So you only combine for these two companies. So the same case, when preparing this consolidated statement of financial position, you are not supposed to combine to consolidate similar items of assets and liabilities, those of the parent, those of the associate, or those of the joint venture. So you should only combine similar items of assets and liabilities, those of the parent and those of the subsidiary. So we have said what you include here, as far as this associate or joint venture is concerned, is this item. You have to compute this item: investment in associate, investment in joint venture. That's what you recognize here. So here, what you recognize as far as this company is concerned is the parent company share of the associate or joint venture profit after tax and other comprehensive income. Other comprehensive what? Income. So basically, that is it. That's what you need to know as far as this is basically concerned. And I think with that, we can look on a question. I want us to look on a question on this. We look on a question on this. And basically from there, we should be done. So what will be remaining is for us to be able to do more questions on this. I want us to start with basically a simple question here. We can start with a simple question. So let's look on this question for August of 2023. Let's go to the question for August 2023. August 2023. So once you get the question, please confirm. August of 2023. And this is question number 3. That should be question number 3. 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 Yes, I hope you are there. I hope you have that question with you. Are you there? Yes, yes. So what are we told? What are we told here? So we are told that Pika Limited, a public limited entity, intend to expand its operation by acquiring investment in other entities. On 1st of November 2022, Pika Limited secured 75% equity interest in Shiba Limited under the following terms. Number one, you're told an immediate cash payment at a fair value of shillings 13 per share on 1st November 2022. Number two, an issue of 3 ordinary shares of shillings 10 per value in Pika Limited for every 5 shares acquired in Shiba. The fair value of Pika Limited shares was shillings 13 at the date of acquisition. The share issue has not been recorded by Pika Limited. So, and then you're told on the same date, Pika Limited also acquired 30% equity shareholding in Amua, paying shillings 24 million in cash. So then we are told the following draft statement of financial position as at 30th of April 2023 relates to Pika Limited and Shiba Limited. So we're given the statement of financial position for the two companies, Pika and Shiba. We have non-current asset, current asset, equity, non-current liabilities, and current liabilities. We have additional information, number 1 all the way to note number 6. And then what are we required to do here? We are required to prepare number 1 or part A to calculate the value of goodwill arising on acquisition of Shiba. From part B, determine the value of investment in Amua Limited as at 30th of April 2023. And part C, we are required to prepare the consolidated statement of financial position of Pika Group as at 30th of April 2023. So before we do that, before we answer our question here, the first thing we need to do, number 1, is basically to come up with a group structure. We said anytime you come up, you come across a question for group account, the first thing you need to do is to come up with a group structure. Then from there, we will go through the additional information. We see, are there some workings which are required? So therefore, let's first of all, we come up with a group structure. So basically working 1 here will be the group structure. The group structure. So which information do we have about this? We are given information about the group structure within paragraph 1. We go back to paragraph 1, you're told Pika Limited, which is a public limited company, intend to expand its operation by entering intend to expand its operation by acquiring investment in other entities. So we are told on 1st of November 2022, Pika Limited secured 75% equity interest in the company which is called what? Shiba. So we are told this company which is called Pika Limited, we are told secured 75% equity interest in the company which is called Shiba Limited, and we are given the date of acquisition, which is 1st November 2022. Remember, this is now the date of acquisition, the DOA. So we are given the terms of acquisition. Those terms, these are the payments which were made. We are going to compute that when answering part A of our question. And then in there is the last paragraph down there where we are told on the same date. I hope you can see that paragraph. We are told on the same date, that is basically this date, we are told Pika Limited also acquired 30% this company on the same date, 1st November 2022, it's also acquired 30% equity shareholding in a company which is called 𝐎𝐍𝐻 Limited. 𝐎𝐍𝐻 what? Limited are paying shillings 24 million cash. It basically means that this company here, 𝐎𝐍𝐻, this will be an associate because you can see the shares acquired lies between 20% to 49%. This is basically an associate. So, but this one, Shiba, this one is automatically a subsidiary company, whereas now Pika Limited will be our parent. So the company which should prepare the group account, we said is always the parent. The group account should be prepared by which company? The parent company. And basically now we have the date of acquisition. Even before you move to computing maybe what is required, we say it is also important for you to be able to identify two dates. The two dates, the date of acquisition, which is abbreviated as DOA, and the date of consolidation, the DOC. The DOC is the date we require to prepare the group account. So we can only be able to get this date in our requirement. When are we required to prepare the group account? Can we go to part C of that question? In part C of the question, we are required to prepare the consolidated statement of financial position on 30th of April 2023. So the date of acquisition here, you can see it is 1st November 2022. So what we need to determine here is, were these companies acquired in course of the current financial year? If you can be able to remember the question we did in our previous class, the question for 𝐎𝐻𝐂𝐔𝐒 and Twende, I hope you can be able to remember our subsidiary was acquired 5 years back. So, but in this case, you can see this subsidiary or these two companies look like they were acquired during the current year, because even year is ending April, the next year will start 1st May, that is 1st May. So it means that this year started on 1st of May, but 2022. So therefore, you can see this date of acquisition, it falls within the current year. So these two companies were acquired in course of the current year. So how many months do we have here? So we can literally count. We have November, December, January, February, March, April, because that year is ending on April. How many months are those? 1, 2, 3, 4, 5, 6. So it basically means that these two companies, that is Shiba and Pika, they were basically acquired 6 months to the end of the year. And we say this is very, very important, specifically when preparing the consolidated statement of profit or loss. If, for example, in our question, though that is not a requirement, if we are required to prepare the consolidated statement of profit or loss. In this case, we say we take the revenue and expenses of this company, that is Shiba, basically for 6 months from the date it was acquired. So we take the revenue and expenses of Shiba for just 6 months by basically apportioning its revenue and expenses on time basis, and then we combine with that of the parent. But in our case, we are not required to prepare the consolidated statement of profit or loss. So therefore, it is important to note that these two companies were acquired 6 months to the end of the year. Now, having that, I want us to go straight to the additional information we see. There are some workings we need to do before we even answer our question. So in Roman 1, let's go to Roman 1, we see what you're told. So in Roman 1, you're told at the date of acquisition, the fair value of Shiba Limited, which is basically our subsidiary here, of Shiba Limited net asset, approximated their carrying amount with an exemption of plant whose fair value exceeded its carrying amount by 10 million. So we said, if you see this, and we say this is something you'll come across in all questions for group account, the fair value adjustment, the fair value exercise, which we said is the devaluation of asset by the subsidiary company on the date of acquisition. So we said because the subsidiary company devalued the asset but never accounted for that, we said in preparation of group account, we make two adjustments, the revaluation adjustment and the depreciation adjustment. So we are told that the plant was valued and basically its fair value exceeded its carrying amount by 10 million. Then in the other paragraph, we are told the plant had a remaining useful life of 10 years at the date of acquisition, and then you're told the plant is being depreciated on straight line basis. The plant is still carried at its carrying value in 𝐍𝐿 Limited financial statement. In other terms, it means that this company revalued the plant but never accounted for that. That's why it is still carried at carrying amount. In the last point of note 1, we are told no fair value adjustment was necessary on the acquisition of Amua. This company didn't revalue the asset. So in that case, what you're given in note 1 is something called the fair value adjustment or the fair value exercise, specifically by which company? By 𝐍𝐿 Limited. So in this case, we said we have to make 2 adjustments as far as this is concerned. The first adjustment, and this is exactly the same thing we did in the other question. The first adjustment is called revaluation adjustment. And actually, we said this is an adjustment which is made in relation to the revaluation gain or loss. So if you check on the information which are given in paragraph 1, this company 𝐍𝐿 did fair value adjustment. The net asset, the fair value of the net asset approximated the carrying amount with an exception of an item of plant whose fair value, that is what is important, whose fair value exceeded, the fair value was exceeded or was more than carrying amount. The carrying amount we said is also known as the net book value with 10 million. But if you check our figures up there in our statement of financial position, our figures will be able to see them in thousands of shillings. We must also be consistent. We are going to work with all our figures in thousands of shillings. So this or the fair value of the plant was more than the carrying amount with 10,000 or with 10 million. So this one automatically is a revaluation gain. We said anytime the fair value exceeds the carrying amount is the revaluation gain. And because this revaluation gain was not accounted for by this company, we said this one will be added to the group PPE. This one should be added to the group PPE. And number 2, we said that this 10,000 is a pre-acquisition revaluation reserve. When computing the goodwill on acquisition of 𝐍𝐿, this will be one of the pre-acquisition reserve we are going to use. So number 2, we make the other adjustment, which is called the depreciation adjustment. Depreciation adjustment. In this case, we said we compute something called the depreciation adder charge. The depreciation adder charge, and that is depreciation adder charge specifically by 𝐍𝐿 Limited. We compute depreciation adder charge by who? By 𝐍𝐿 Limited. I hope you can be able to recall the formula which we use here. We said we take what? The revaluation gain, the exact thing we did in our question, in the other question, the revaluation gain. We divide that with the remaining useful price, and then in this case, we multiply that with the proportion of time. Proportion of time, of which we said proportion of time is basically the time we have from the date of acquisition to the date of consolidation. And I hope you can be able to recall here, that from the date of acquisition to the date of consolidation, I hope you can be able to recall we have how many months? 6 months. So these 2 companies, or actually 𝐍𝐿 was acquired 6 months to the end of what? To the end of the year. So this formula is what you need to remember always, is what we use in computation of what? The depreciation adder charge. So therefore, to compute this depreciation adder charge, we take the revaluation gain, which is this one, 10,000. 10,000. We divide that with the remaining useful price. So what is the remaining useful price of this plant as per the information we have in note number 1? As per the information we have in note number 1, we are told paragraph 2, the plant had a remaining useful price of how many years? Of 10 years. Of 10 years. I hope you can be able to see that. Of 10 years. So that is the remaining useful life. And then we multiply that with the proportion of time. The proportion of time here will be 6 all over 12. 6 all over 12. That's basically how we compute the depreciation adder charge. If you take on what you have done in this question, whatever we did in the other question is just the same. It's just the same. And basically I've said that this is an adjustment you will come across in all questions for group account. In all questions for group account, you'll be told the subsidiary company on the date it was acquired, it revalued the asset. You must be able to record the adjustment which you make as far as that is concerned. So this will give us what? This will give us 1,000. A half of that is 5 what? 500. I hope you're getting 500. So this 500 will be adjusted in which two items? One, this one will be deducted from the group PP in preparing a consolidated balance sheet. And then we also deduct it from the retained earnings of this company. The retained earnings of this what? Company. Now, if in this question also we were preparing the consolidated statement of profit or loss, this one we said we added to the group cost of sales. But automatically this adjustment is not necessary simply because we are not preparing the consolidated statement of a profit or loss. So we will just add that, less that from the group PP, we less it from the retained earnings of who? Of Sheba. Of who? Sheba. So let's move to point number 2. In point number 2, we are told that on 28th April 2023, 28th April of 2023, this is basically some few days to the end of the year. So we are told Sheba Limited, which is this one, sent goods at an invoice price of 7 million to Pika Limited, which Pika Limited neither received nor recorded until 5th of May 2023. I hope you can be able to remember what is that. Automatically, that is now what we refer as the goods in transit. The goods in what? In transit. These are the goods which were sent by this company, but when the year was coming to an end, this company had not received nor recorded those goods. So we refer to them as goods in transit. The goods in transit. The goods in what? The goods in transit. Goods in transit, the GIT, the goods in what? In transit. Now, we said as far as these goods in transit are concerned, we make 3 adjustments. There are 3 adjustments which are made here. That is basically what you need to remember from our discussion. We said we make 3 adjustments. The first adjustment is basically to recognize the goods. To recognize what? The goods. That's the first thing you need to do. To recognize the goods. So these goods which were sent by this company, but when the year was coming to an end, this company had not received and accounted for them. So those particular goods, they had a value of 7 million. Even before we go to the last paragraph, to the next information which is given here, the goods had a value of 7,000,000. So how do we recognize these goods in the books of account of the parent? So if the parent company had received these goods, the parent company or these goods were supposed to be part of the inventory of the parent and part of the payables because the parent company had not paid for them. So therefore, these ones, we will add them to the group inventory. That is first adjustment. And then number 2, we add them to the group payables. So those are the 2 adjustments which will be made to recognize those goods. So if this company had received those goods, they were supposed to be part of the inventory and still part of the payables. Part of the payables. So then the other adjustment which we need to make is the adjustment for unreleased profit, because automatically this company made some profit, but automatically the entire profit was not yet realized. This company had not received those goods, so mean that the goods were not yet to be sold to the third parties. We make adjustment for unreleased, we compute the unreleased profit, and also these goods will give rise to amount of intercompany debt. But before we do that, we can go through the other information which are given in note number 2. Specifically the last sentence of paragraph 1, we are told Sheba Limited, which is basically the company which sold the goods, had marked up these goods at 25% on cost. And then you are told the last paragraph, the agreed trade payables record in the books of Pika, the agreed trade payables recorded in the books of Pika Limited before the above transaction of 6 million. Okay, so before we do that, let's first of all we compute the unreleased profit on these goods, unreleased profit on the inventory. So the unreleased profit on the inventory. So because we say that these goods were not yet received by this company, so mean that the profit which was made by Sheba this profit was not yet realized. So this profit is by the selling company, which is Shiba. So how do we compute this one? We take the goods in transit, we multiply that with the gross profit margin. So the goods in transit had a value of 7,000. That is the value of the goods in transit, this one, times the gross profit margin. Are we given the gross profit margin in that question? Are we given the gross profit margin? No. Whatever we are given is the gross profit markup. We are given gross profit markup as 25%. 25% as a fraction is 25% all over 100, which is basically a quarter. So if we have that as our markup, how do we compute the gross profit margin? We say this one will be equal to 1 all over 4, and then to this we add the numerator. So this one will be 1 all over 5. That is our margin. So our margin, therefore, here will be 1 all over 5. So give me the final figure here. The final figure here, which is 7,000 divided by 5. So that will give us an unrealized profit of 1,400. So this unrealized profit one will basically be deducted from the group inventory. And number 2, we also deduct this from the retained earnings of Shiba. So the other adjustments which we need to make as far as these goods are concerned is an adjustment for amount of intercompany debt. Remember, this company plus now this one, 7 million. This is the total amount of intercompany debt. So this total amount of intercompany debt, this one, 13 million. This one, recall the adjustment. This one will be deducted from the group receivables and also from the group what? Payables. And remember, this amount of intercompany debt is the same. So it will be deducted from the group receivables and also deducted from the group what? From the group payables. The amount of 13 million. So having that, we need to move to the other point. So therefore, if you come across that adjustment or that item, the goods in transit, you have to recall those 3 adjustments. Recognize the goods, compute the amount of the nearest profit, also they give rise to amount of intercompany debt. So number 3, we are told a PICA limited policy is to measure the non-controlling interest at fair value on the date of acquisition. We say this information is to help you compute the goodwill. LCI is to be measured at fair value. When computing the goodwill on acquisition of the subsidiary, we use the full goodwill method. We are told for this purpose, the directors of PICA Limited consider Shiba Limited shares Shiba Limited share price of shillings 12 per share to be appropriate. In this case, we are not specifically given the NCI at fair value, but I'll be able to show you how we compute that specifically when answering part A of the question. So, but when computing the goodwill on acquisition of Shiba, we are going to use the full goodwill method. Then number 4, we are told impairment test performed on 30th of April 2024 at the end of the current year revealed that the goodwill on acquisition of Shiba Limited had not impaired. We don't have any impairment loss. And then we are told, but due to the declining sales of Amua, which is the associate, the value of investment in Amua had been impaired to an extent of 2 million. So this is an impairment loss in relation to the investment made in Amua. So we are going to use that in answering part B. And then number 5, we are told Amua Limited reported profit after tax of 4 million during the current year. Also, that one will be used in answering part B. And then we are told number 6, assume all the profit and losses of the 3 companies accrued evenly throughout the year. So I think no workings which are required there. So what we need to do, we can go straight to answering part A of the question, basically whereby you are required to compute the goodwill on acquisition the goodwill on acquisition of what? The goodwill on acquisition of 𝐻𝐍 Limited. Remember, in this case, I've said, as per the information which are given in note number 3, we are going to use the full goodwill method. We will use the full goodwill method because we are told the policy of the group is to measure NCI at fair value. We said if you come across that information, then compute the goodwill using the full goodwill method. So in this case, we need to have two columns here. So what do we start with here? We always start with the purchase consideration. The purchase consideration which was paid by the parent, company. And then to this, we will add the purchase consideration paid by the NCI. So the purchase consideration paid by the parent company, this information, we have it below paragraph 1. So let's go back to paragraph 1 of our question here. Paragraph 1. In paragraph 1, we are told Pika Limited, which is our parent, a public limited entity, intends to expand its operation by acquiring investment in other entities. In the last sentence, we are told, on 1st April 2022, Pika Limited acquired or secured 75% equity interest in 𝐻𝐍 under the following terms. We are given the terms of acquisition. We are told an immediate cash payment at a fair value of shillings 13 per share on 1st November 2022. So in this case, we are told when the parent company acquired 75% of 𝐻𝐍, there was a cash consideration. The cash consideration, that immediate cash payment. Immediate cash payment, if you can be able to recall, we refer to that as what? As cash payment. And in this case, we are told the amount which was paid here is 13 shillings per share. 13 shillings per share. Now, you may decide to compute this. So basically, to compute that, we should take 13 shillings. 13 shillings, you multiply that with the shares acquired in 𝐻𝐍. The shares acquired. The shares which were acquired. But there is no need of computing this because this value is given in the statement of financial position of Pika. Can we go to the statement of financial position of Pika? Specifically where we have the non-current assets. In the statement of financial position of Pika, under the non-current assets, we have PP, property, plant, and equipment. And then from there, we have investment in 𝐻𝐍. Investment in 𝐻𝐍, you can see we are given 6 million shares at shilling 16, at shilling 13. So meaning that the shares which Pika Limited acquired in 𝐻𝐍 were 6 million. So 6 million times the amount which was to be paid per share, which will give us what? Which will give us 48 million. 48 what? Million. So, and why are we told the shares acquired were 6 million? So we can first of all determine how many shares are issued by this company. The shares issued by 𝐻𝐍, you get that from the balance sheet of 𝐻𝐍 at the equity. At the equity, the share capital of this is 80,000. So for us to be able to know the shares issued by 𝐻𝐍, we will divide that with the par value. And I hope you can see the par value where we have the word ordinary shares in the balance sheet. The ordinary shares of this company, they have a par value of 10. So the shares issued by this company are 8,000. So the shares Pika Limited acquired in 𝐻𝐍 were 75%. So if you get 75% of this, that basically will give you 6,000. Alan, what are you referring to, 78 or 48? Okay, so the price is okay. This one should be 78, not 48. Yes, so that one is okay. It should be 78. Yes. So therefore, the cash consideration here is 78. 78. So 13 shillings times the shares acquired. Then I want us to go back to the information we have below paragraph 1, because other than this cash consideration, in point number 2, we are told there was an issue of 3 ordinary shares of shillings 10 per value in Pika Limited for every 5 shares which were acquired in 𝐻𝐍. If you can be able to recall, we refer to that as the share exchange consideration. The share exchange consideration. So for the share exchange consideration, you need first of all to remember the formula. How do we compute the share exchange consideration? The share exchange consideration. In this case, we say compute the number of shares which were issued by the parent. Issued by who? The parent company. So this one we said the examiner will not give you this one, and then you multiply these shares with their fair value or market price on the date of acquisition. So this is something we are already given. In that point. In that point, we are told the last sentence of that point 2, we are told the share issue. Okay, not that point, but point number 2. There is one somewhere we are told the fair value of Pika Limited shares was shillings 13 per share on the date of acquisition. So the shares of the parent company on the date of acquisition, they had a market price or a fair value of shillings 13. That one is already given. So what we need to do is to determine this. How many shares were issued by the parent company to pay the purchase consideration? We are going to use that information we have in point 2, where we are told an issue of 3 ordinary shares of shillings 10 in Pika. So Pika here was to issue, Pika Limited was to issue 3 shares for every 5 shares which were acquired, for every 5 shares which were acquired. So in our case, do we know how many shares were acquired by Pika in Shiba? Do we know how many shares Shiba Limited acquired in Pika? Sorry, how many shares Pika Limited acquired in Shiba? Do we know how many shares were acquired by our parent company, the subsidiary? Do we know how many shares were acquired by the parent company in the subsidiary? Do we know how many shares were acquired? Do we know how many shares were acquired? How many shares did the parent company acquire in the subsidiary? How many shares were acquired? How many shares did the parent company acquire in the subsidiary? How many shares were acquired? We have already dealt with that somewhere here. Just now. Yes, we have said the shares which were acquired were 6 million. We have computed that here. We have said that this one was also computed based on 6,000 shares which were acquired. The shares which were acquired were 6,000. So what we just need to do is to cross multiply, then we divide. So therefore, the shares which were issued here will be, because we need to cross multiply, then we divide 3 times 6,000 divided by 5. So this will give us 12.